Hello, hello. Let's get through the technicalities first. Audio all good, and can you see the screen? All right. Good morning, good morning. Good morning, Sam. Morning, Morris. Good morning, Alfred. Hello, hello, Sridhar. Sam is saying, any thoughts on this week's insanity? I was fully here and had no idea. It was exciting week. I'm not sure if call it insanity, but it was a eventful week. That I would definitely say. Morning, Shri. So definitely very, very eventful week. Maybe I think there was one thing which was eventful. Other thing was a nothing burger. Uh, we'll get through it. We'll get through it when we look at what happened in the market and even outside the market that impacted market a lot. Well, why did you buy MELI? Yes, I will talk about it. I will talk about it. So MELI, I think I do have it on for agenda for reviewing during earnings. I have a lot of companies that we can review about earnings. We'll see how much we can get through it in our assigned time. And I do have a hard stop. We have to go somewhere. In case you're wondering why I'm dressed up like this, I had a choice to make. Uh, it's a festival season, and we still have, Diwali parties happening. So my boss gave me two choices. Number one, either you finish session earlier and then get ready. I'm like, no, you know what? I'll probably spend 15 more minutes in the session. I'll get ready and sit in the session in the dress that I need to go in the party. So straight away after the session, we'll just head out. I don't want to spend time in dressing up, rather use that time in talking to you guys. So I'm like, you know what? I'll just I'll just sit in my attire for the meeting. Hey, thank you, Aditya. Yeah, so host specifically mentioned, Indian attire. I'm like, oh, okay, whatever. Uh, so Tesla after Trump, oh yeah, Tesla. Look at Tesla. And everyone, this is where the secondary impact that we can't figure out. So Trump winning, the first order thinking will tell, oh, that's bad for EVs, right? Trump is not in favor of EVs, right? So what happened? Why Tesla like ripping up? Right? The problem is that it's even will be worse for the remaining EV companies. And of course, then you got an Elon Musk. Now he has a much more say on in administration. So if you're wondering, I think I saw somewhere a chart. I don't have it handy right now, which is like if Trump wins these sectors, if Kamala wins, these are the sectors which will go high. And definitely green energy EV was not a sector that you would expect to go high if Trump wins. Well, look at what happened to Tesla. Let's look at what happened to Tesla. Like it's up almost 30% after Trump win. Like close to 246 all the way to now 325. It closed close to 322. So yeah, this is what call as second order thinking. We might get our first order thinking right, which is, hey, these sectors will not perform good, but we never know how the markets will react. That is why it is so difficult to predict on the markets. She said, your boss gave the option. That's good. Yeah. I'm lucky that she told me, all she told me, you have to leave by this time. Now you go. I'm like, give me a freedom. You tell me the deadline and let me decide how I want to, go ahead. Don't tell me that you finish your session earlier. Don't tell me that. You tell me what time you want me to leave. I'll figure it out myself. So 12:15, I have to leave. So will not go till 12:30. What sectors are expected to pump with the Trump win? Let me see if I still have a reference to that chart somewhere. I did. I mean, of course, we'll talk about a few of the sectors, but there was a chart. I don't have it nicely in the chart handy with me, but I think there are few sectors that I will talk about which are anything which is related to a little bit regulated sectors and drill sectors, those expected to perform better under Trump. So we'll spend a little bit time on that one. Overall sector. So what else before we jump into today's session? Cool. Freddy sharing a chart. Too many lines on that one. I don't even know how to make use of that one. Alrighty. So let's get going then, guys. Buffett sold more of his Apple holdings. Yeah, I know Buffett is, I think by now he has sold what, 60% of his holdings, and his cash pile of Berkshire Hathaway is now, I think it is $325 billion, if I am not wrong. Like, can you imagine 300? And I mean, he is happily sitting on $325 billion worth of cash, earning whatever 5%. It's difficult to deploy such a big capital. So this is the curse of being big, right? If someone had asked Warren Buffett that, hey, if I give you $10 million, he said, if given a $10 million, I can achieve 50% CAGR for next 5 years. Given if you have to deploy $200 billion, it's impossible. Right? So the bigger the fund or bigger the capital available to deploy, difficult it is to to compound it at the same level. So if you are seeing someone on Twitter, YouTube, Meetup, in party talking about, yeah, I'm up like 100% this year. And there are many. I mean, it is easy to get 100%, but the question that you need to ask is, what's the capital that he's talking about? If you made from 20,000 to 40,000, wow, yeah, not a big deal. It is difficult to deploy and compound at the same higher and higher percent, the bigger your capital size becomes. Something that should definitely look into. That's why I don't want to follow or just based on your return, just don't follow folks saying, hey, somebody has made 50 or 60% return this year when S&P has given only 25%. You never know what's the amount of a risk they've taken, what's the capital that they've started with. A lot of stuff come in picture. ASML fell further. Yeah, a little bit, but I'm not too worried about it. So I'm still holding ASML. So what I have today, let's see, maybe we'll change the schedule based on what the interest will be. But last week I talked about, well, let me see, is there any other question that I need to answer? All right, so I think look through all the current questions. So, all right, so let's get started with today's session. Welcome everyone for session number 255 of our weekly meeting. So thank you for showing up every week, and love talking about investing, whether it is stocks, bonds, IPOs, or some of the exotic instruments that we are seeing. And nowadays I'm seeing a lot more exotic instruments in the market trying to go for retail investor capital. So if you have something that you want to talk about, do let me know. But today on my list, what I had was maybe give you a rundown of a 230-page report from McKinsey, which talks about the sectors that they think might outperform the rest of the economy for the next 20 years, right? Next 10 to 20 years. So this is what I had hinted in our last week meeting. So that's one big topic. And the other big topic is, of course, earnings. We are still in the thick of earnings. I think almost all the big trillion-dollar companies' earnings are out, but there are still a lot of companies that are still reporting the reported results this week. And of course, the 800-pound gorilla of this week is around a presidential election. So we'll look at what happened in the markets, what sectors why some of the market performed the way it had performed. We'll look at some charts, all that stuff. So that's on agenda, and we maybe, if we want it, we can switch the sequence of it, but do let me know. Okay, that's on my list. Ross says an observation: markets run up due to election outcome may not have been a surprise, as earnings always happen during this time. So we will look at in terms of I think there's some number around market run up, and I don't recall it. In some of our previous meeting, did we look at how many after election, how many times did the market run up and how many times it did not? All segments that will benefit from deregulations are up. Yeah, exactly. So there are a few sectors that went up because now we have a Republican administration, and anything that are regulated are getting the tailwinds. Cool. All right. So let's get started. As always, everything that we discuss here is only for education and a little bit of an entertainment. If you can find any, don't take it as a financial advice, guys. I'm not a financial advisor. I've spent most of my life in technology sector, so you cannot do anything worse than taking financial advice for me. So do your own due diligence. I love to analyze stocks. I love to analyze reports, and that is what we'll do. I'll bring you my thesis. Feel free to contradict me. Actually, I love you if you can contradict me so that I'm not sitting in an echo chamber. It's always healthier if you have a different viewpoint. Okay. It's Bobby says, can you provide the link? Yes, I have a link handy and I will give the link once we reach there. We have 4 upcoming years of entertainment now as well. We're gonna have fun for sure. It's you know the next 4 years will be fun. Now, whether it will be beneficial or not, that I don't know. Last 4 days have been beneficial for the portfolio. Rest we will see. Right? We already had 2 years of bull run. Markets up more than 25% last year. So far, it is up more than 25%. And if you recall, I think 2 weeks ago, we looked at the chart. How many times has it happened when we actually got 3 consecutive 20% plus gains? I think last 75 years, it's been either never or only once. Right? 2 consecutive 20% plus gains have happened, I think 5 times. I don't recall exact numbers, but we looked into it maybe 2 or 3 weeks ago. There was a nice chart. So I don't know, 2025. If the earnings continue to compound as market is expecting it to, we might have a new record. Right? Things that have not happened in 75 years might happen now. So we don't know what's going to happen next year. I have no idea, but trying to time the market and it's been a fool's errand. So I won't even try. Ross is what follows after 3 years of 20-30% gains. I don't think I have a chart for it, but good question. I think somewhere in one of the sessions I had shared from 1929 onwards, the S&P returns what the S&P returns were every year. So maybe next week will be a good week. Maybe we go back and revisit that chart to see what had happened after 3 consecutive years. I mean, on an average, market is supposed, or not supposed, but on an average, market has a correction every 3 years. Once in a 3 year, you have a correction. And then once in 5 years, like once in a 3 years, you will get between 10 to 15% drawdown. Once in a 5 year, it will go down to 30%. So I really don't bother. So we have to be ready with it. If you are investing in a stock, we should assume that the market will go down once in 3 years. Right? But still, we got a better chance, right? 2 out of 3 is still bullish, long term. Short term, I don't know. Maybe we can get 2 years of negative return, possible. It's the oldest bull market in the history. I don't know, because 2022 we did not have, so it's right now only 2 years. But if we ignore 2022 And then, then we've been having bull market since I think 2012 or something. It's the longest one. Who would have thought after that great financial, the crisis of 2008, 2009, and feel for the folks who would have been invested, who had invested in 2000, prior to 2008, and then got scared out of the market. And it is psychologically very difficult to get back in the market if you have gotten out at a lower level, trying to get back in at a higher level, psychologically very difficult, right? And if you're sitting on the sidelines, you missed one of the best money-making opportunities of the decades, right? For almost 15 years of bull market. Of course, it did not come, as a straight line bull market. It came with own volatility, but that's the price that we have to pay. Otherwise, there are bonds. Even bonds have been volatile, right? 2022 was like a very weird year in which the bonds were down 18%, I guess, and the market was down 22%, or somewhere around that. So that's a very weird year. It's a general thesis around, hey, invest in stocks and bonds that give you diversification. All those rules have been broken now because of Fed involvement in the market. We had 2022, bonds were down, stocks were down. Where are you going to go and hide? If you are a retiree depending on bonds to provide you with a cushion, when the stocks go down, that didn't help in 2022. All right, so happy is certainty. One thing which market doesn't like, and which is true in every scenario, is uncertainty, right? Even if the certainty is bad, but at least we know the end result is, even if the end result is not good, but the fact is that, hey, now I know that this is the end result. Markets love it. We have seen it time and again. Sometimes you'll see that a company has been fined by SEC and the stock has gone up. What the heck happened? Hey, because now we know what the overall financial impact is, right? Or a judgment against, let's say, class action lawsuit has been passed and the stock went up. Because now we know what's the overall financial fine has been. Before that, there's uncertainty. You never know. Is it going to be a $100 million fine? It is going to be a $5 billion. But once the result is out, then okay, I like the certainty, and that's what market likes, certainty. So we had two events this week. One is one of the most consequential events of the recent times, and then the other one was the least consequential. So let's first get through the most consequential event, which was a presidential election, right? So we're not here to talk politics, so I'm not going to get into the merits of, why, who is in the White House, or, who is controlling Senate or House of Representatives. But we only look at from a perspective of from investing or from how it impacts the markets. So what happened? We got a decisive result for Republicans. Donald Trump will be back in White House. He's not yet. We still have, sometimes we even forget that President Biden, he's still the POTUS, right? So, but President-elect is Donald Trump back in the White House. I think it's the first time, or maybe second time in the history, that we have a president who is having a second term after a gap, right? I think it has happened only once. Somewhere I heard that it's only the second time that we have a second term of a president after a gap. So, but it was a resounding victory. Looking at like 301 versus 226, it was not close. So, even though some of the results may be coming in, I don't know. But, there is no dispute. This was unlike our previous result, the previous presidential result, where it was little closer fight, and then we had little uncertainty in terms of, hey, can the result flip and all that. But I think this time it was no question asked. There was a resounding win for our Republicans. They also got a control of Senate, 53 versus 46, and they are still leading in House of Republicans. So House, they are still leading. I think they're pretty confident that they also win the House. So that's going to be a clean sweep. We got the House, we got the Senate, and we got the White House. So there should not be any excuse of not implement your agenda now, because now you control all the three functions, right? So, and I think that's what market now likes, the certainty. And the stocks saw their best ever post-election rally. S&P was up 2.5% the day after election. And that's been the best post-election return in the history of stock markets. I think this IWM or Russell, that was up, I think, more than 5%. That's amazing. And of course, if you look at individual sectors or individual ETFs or the stocks, some of them were crazy. But even if you look at an overall market, it was up 2.5% just in a day. And after that, it still continued to go higher. So some numbers, since 1930, there have been 23 elections prior to the current one. So ignore the current one, with equities rising the day after in 9 times. So out of 23, looks like after election, 9 times the market was up. I think there was a question, I forgot, was it Ross or someone asked that generally it goes up. So maybe during the season it goes up because it's earnings season, but just after election, looks like it's 9 times out of 23 that the market was up. But in all cases, S&P was higher 10 days later and remained higher 3 months after in 7 cases. So stock rising the day after election means further short-term gains, but year on, stock is generally tend to rise. And so we have seen this post-election rally at a different time period and multiple charts now, right? And I think at a high level, all of them have indicated that a year later, the market generally tend to perform 60 to 70% of the time, it performs high. Okay. What's the reason of optimism currently? Now, this is, I think, the question someone asked, what are the sectors that are going high? And currently, the reason of optimism is extension of tax cuts for individuals, and maybe there could be a corporate tax rate cut also. Right? Donald Trump, in his election agenda, has talked multiple times that he's gonna cut the tax rates. Now, election agenda and the promises are different than what might happen. But now the fact that we have Donald Trump now has control of Senate and maybe control of House as well, it will be easier to pass and get done whatever you want to do. So if you get another further corporate tax rate, that will be good for those for the stocks. Deregulation initiatives. I think this is the major factor that had contributed to some of the gains that we have seen. Look at the gains in the financials. Right? Banking sector is a regulated sector. So if we'll have a little more deregulation, less regulation, that'll be good for those sectors. So we saw financials, regional bank were up 10% after the results were out. Right? We will also see more uptick in business deals, especially for the last, number one, that because of the increase in the interest rates, we didn't have many of the IPOs, etc. happening. Number two, if you don't have IPOs, what's the other way for VCs to get their liquidity? You basically do a merger and acquisition. So over the last 2 years, both of these avenues for either capital raising or giving return to LPs have been shut down. Not much happening on an IPO. Of course, there are smaller companies that are going IPOs all the time, but compared to prior years, we haven't had big IPOs. You can count on your hand how many big IPOs we have had this year. We had Reddit, we had ARM, a few. I cannot recall big names. So because the markets, I mean, we still have a higher interest rate and all that. IPO is not happening. Merger and acquisition have been killed by Lina Khan. You can't, as an Amazon, you can't buy Roomba, right? And I think very recently, Tapestry and which are two luxury bags, right? The luxury bag, luxury purse companies. One is Tapestry. I forgot the name of other, right? And the Justice Department said they're gonna block that deal as well. So, and there was another airline merger which also Justice Department said they're gonna block it. So merger and acquisitions not happening, and IPO is not happening. So the whole the the capital markets have been tight. So now we might see, number one, we will see a replacement on the FTC chair. We might see another commissioner, maybe a little more favorable to mergers, etc., might step in, and hence we'll see a more uptick in the business deals. And that means a lot of money for Wall Street firms, right? um, all these M&A fee and IPO fee contribute a meaningful revenue to Wall Street firms like Goldman Sachs, and you'll have to look into individual Wall Street firms to see where the majority of revenue come from. For example, I won't expect Wells Fargo to outperform, let's say, Goldman Sachs, because Wells Fargo is still a traditional bank, even though now all the banks have the investment banking firms, but still majority revenue for Wells Fargo comes from traditional banking side, whereas let's say JP Morgan and Bank of America, they might have a higher portion of revenue as compared to Wells Fargo coming from their M&A and investment banking side, and that will do good because we will have a lot of activity within the corporates, right? So that's expected to perform well. Hostility in the crypto sector might end. Gary Gensler might be changing. I mean, there was a meme on on Twitter around Gary Gensler changing his LinkedIn profile with now putting open to work label. Uh, those who have been watching crypto sector, I mean, we know what's been happening or in that sector, right? The whole hostility from Warren, Senator Elizabeth Warren, and her followers in the Senate and on the House, just didn't almost killing this industry. Choke point 2.0 it's what we have seen. So hostility against crypto might end, and that also we saw a lot of companies related to crypto went high. So these scenarios, and of course we might get further lower interest rates. If you recall, in his first presidential term, Donald Trump was, I mean, even though that's not a part of, that doesn't fall under presidential power, who cares? Donald Trump doesn't care what power does he have or not. He'll say what he has to say, and I recall him calling on Chairman Jerome Powell to cut rate, right? And he was like, "We should go negative interest rates." I don't know that's we should do that or not, but he is definitely in favor of lower interest rates. So if you have a lower interest rates, that's great for smaller cap companies. That's great for the companies that we see in Russell 2000, right? IWM. And that's why if you look at, let's go to IWM. Look at it. Yes, this is land fire from 220, now sitting almost 240. It's up 10%. 40% of the companies in Russell are like zombie kind of a companies. They don't make any money. They only survive or are still alive because they have a loans which they continue to roll, right? They don't generate any operating profits. So if you can roll your debt at a lower interest rates, that's helpful for them. And that is why we saw a huge move in IWM or in Russell immediately after election. It was up like 5% or 6%. Right? So, and of course, financial services sector, I talked about mergers and acquisitions, IPO, that's a windfall gain for financial services firm. Regional banks rising 10% because we have a lighter banking regulations, right? And lower capital requirements. I haven't yet gotten into the details of the Basel 3 endgame. First of all, I hate the name itself, like Basel 3 endgame, but I guess that's related to little more stringent capital requirements on big banks and all that. I have heard some of the banking CEOs coming against it. And now with the new administration, if the whole Basel 3 endgame is put on the back burner, that's gonna be great for the banking sector. Asset class return post election day. Yeah, US small caps, that's like almost 6%. Right? Mid caps were up 4%. So overall, number one, market loves certainty. Number two, with the Republicans in the White House and on Senate, market loved the fact that we're gonna have a lower interest rate, little more deregulations, and a lot more economic activity happening. Right? So pretty happy. Market pretty happy about it. And look at this is like what last 1 week performance. Right? Mostly green. Microsoft up 3%. Look at Tesla is up like 29%. Who would have thunk that Tesla will go up almost 30% just because of elections? Prior to election result, Tesla had been underperforming S&P. Now it's like handsomely outperformed S&P. What's the Tesla's year-to-date gain? Oh no, it's actually up only 29% year-to-date. So all the gains in Tesla that we see year-to-date gains have just come in over last 4 days, I would say, or 5 days, in last 1 week. Prior to last 1 week, Tesla was like returned nothing for this year. And this is why, you never know. If you ever invested in Tesla and just lost your patience saying, oh, come on, guys, the stock hasn't performed. It hasn't gone anywhere in the year. So this is where it started. Like say year was 206 or 206 to 10, right? Hasn't done much over the year is here. This is why the new year has started, right? It's like 240, 245. And Tesla was exactly around 245 before the election result came out. And then boom, boom, boom. 4 days, you get your 30% gains. I don't know if it is, uh, how sustainable this is. There's all components involved in this iron because Tesla is a very liquid stocks, so easy to short because there's enough liquidity. So there might be a short squeeze going on out here. Who knows? But this is where if got frustrated and sold off your Tesla, and then now you'll be seething, saying, "Gosh, I missed out on this 30% upside." If you wanted to sell any time in the year, I mean, this week, last Friday was the best year to sell Tesla. I'm not saying that you should sell Tesla, but over the last, I guess, 2 years has been the best time to sell Tesla. Ross says, will inflation rise if the rates drop? Probably not, and that's what I think the Fed has been a little more cautious because they are seeing that the inflation is still on its path to 2%, whatever the 2% is. I don't even nowadays believe that whatever the official numbers are, because that doesn't, my household doesn't see that number. My household see much higher increase in the expenses, but it is what it is. Fed look at PCE, and I think Fed thinks that we are on our path to 2%. Now, if inflation starts to rise and if Fed pivots, and the money becomes more restrictive, then market should get a little bit of a jitters. How will the tariff proposals affect the market? So there's going to be a fine balance which the Fed will have to, because if you're going to impose tariffs on China or on imports, that means the cost for us will go higher. So that means then the inflation might go higher. And this is what exactly I think I have a chart around. Even though the interest Fed has cut the interest rate in October, Fed cut it by 50 basis points, the yields have gone higher. Bond market investors are seeing something which stock market investors are not seeing. Bond market think that this euphoria in the stock market is unjustified. Bond market thinks that we might have the inflation might go higher. And so the bond market, the yields have not gone down. Even the Fed, after Fed has cut the interest by 50 basis points. So I have a chart, we'll look at that. In fact, the yields have gone up, which is very surprising. What are those bond market vigilantes are seeing what the stock market investors not seeing? Well, we'll see. Ross says tariffs are inherently inflationary. Yeah, tariffs are never good. Tariffs are not good. It for general economic conditions. I think if you're imposing tariffs so that we can get more production in-house for strategic reasons, because one thing that COVID has taught us is it may not be in the best long-term interest to always try to optimize for the cheapest price. Right? What good is the cheapest price if the goods are not even available? Right? It's like Senator Warren keeps on saying we should squeeze the whole food inflation is because the corporates are greedy, and we should penalize them. There's a price gouging going on in groceries markets. I mean, Madam Warren, have you ever looked at the margins in the grocery market? Those are paper thin margins. And if you squeeze or penalize those grocery companies, and then they might reduce the prices, but the shelves will be empty. Yeah, you can get meat cheaper only if you can find a meat. They will not. Why would you produce at a loss or at a margin which doesn't make sense to you? So let the market let the competitive dynamics decide what's the right price. And I don't think that the margins of groceries are price gouging. And the price is going higher because of other reasons. So will we get so over, I think, 1980s, 1990s, 2000s, all the focus was on just in time, cheaper pricing, globalization, let the produce at the cheapest place, get it when you need it, so you don't have inventory cost, nothing else, so that we can finally have the goods at the cheapest possible price. What COVID taught us was that may not be the right strategy in some cases, especially if you're talking about things that are strategically important to the nation. What good is the cheapest price if we don't even have those goods? So I think maybe if we want to increase the tariffs so that we produce a little more, or we encourage the companies to come and set up shop and plants in US, like we are forcing like TSMC to do it so that we can make some chips back, semiconductor chips back in US. We know how to make potato chips, but we've forgotten the art of making semiconductor chips, which are way, way, way more important for the next future. And yes, now TSMC is setting up a plant here. So it is possible that we may want to get back and get control and know-how on how to make certain things which are strategically important for us, because the world is now becoming a little more divisive, right? After the end of Cold War, now we are seeing the dynamics, the geopolitical dynamics in the world is getting little tricky. We got China, Russia, and North Korea, and their friends making one block. We got a West making their another block. And then if all our chips are only coming from the east side, what might happen? Right? So different viewpoints. So yeah, inflation may go high, but that's the cost we may have to pay for maybe adding back jobs in manufacturing sector in US. So that's a cost we have to pay. There is no free lunch. There will be some cost that we may have to pay. And I think as a country, we have to decide what cost is worth paying. Can Tesla go more than 350 this week? I have no idea. I mean, if I had a crystal ball, I will load up on Tesla. But I don't know. I mean, no one knows. you can you can only look at the what market is thinking about it, but whether that will, there is no certainty. So one thing which I learned around investing is, and it became much, life became much better, that investing is not deterministic. Always invest with a probabilistic point of view, right? Whether I'm going to make money, maybe the probability is higher. Right? That doesn't mean that you're definitely going to make money. Right? And be comfortable with that. Investing life become much easier. Whether Tesla will go to 350, I don't know. Is there a probability of Tesla going to 350? Yes. Now we can look at an option change to figure out what's the delta of 350 is. That will tell you what's the probability of stock hitting at 350, what based on the option trades that the market is doing. But that does not mean that it's a certainty of, like, if 60% probability doesn't mean that it will happen in the next week, right? 6 times out of 10 it will happen. There's 4 times when it doesn't happen, maybe the next week it may not happen. So investing becomes much easier if you start thinking in a probabilistic term. And that is why I guess most of the great investors, they are all card players. They love playing cards because not chess. Even the chess is more IQ heavy game. Chess is a deterministic game. Card games are like, and I don't play cards. I have to learn. I want to learn how to play poker or a bridge, because if you listen to, even I think I was listening in one of the big hedge funds. I think is it Jane Street or one of the big Wall Street firms. They actually have a I think poker game for the traders. It'll teach you how to think in probability term, right? So 350, I don't know, but we can look at an option chain and see what's the probability that market is pricing in. But that's not a certainty. So never invest based on certainty. And that's why I like options, because it helps me, and you can pick your probabilities and work accordingly. US has fallen almost 25 years. We can rare earth. All rare earth materials, minerals come from China. There was a chart that I saw a few weeks ago in terms of what we produce here and what we import. There were a few things that we import. 100% of it. Some of them are rare earth materials which are used in the chips. We import 100% of it from China. So I don't think any administration is completely right now gonna go 100% against and cut off China, because we are so much dependent on them. We have to build that sovereignty first before we try to cut off China completely. All right. Net, we still have positive fundamentals for our economy. The fundamental conditions that drive long-term performance, they are more favorable right now. Consumer spending is still, the market has been expanding above average because the consumer spending is still robust. Very, I would say, high IQ analysts on the Wall Street were predicting recession in 2023. Didn't happen. Then it started. Okay, in 2024 we'll get a recession. Hasn't happened. If every year you come and say, "Oh, this year gonna be recession," or this year we will have a stock market correction, which means maybe we'll go down. We'll have a bear market, which means we are down 20%. One of the years it will happen, right? And that year, everyone will put you on the pedestal. They'll treat you like a god. But you can't predict every year what's going to happen. That's why you shouldn't pay any much of attention to what the Wall Street firms are saying. Every dog has its day. Every analyst has its year. Right? I have not seen anyone who has been able to be consistent in their predictions. Corporate profits are expected to rise 14% in 2025. I think last week we saw a chart, and that time we were actually talking about, hey, we were up like 26, whatever, 22%, 26% last year. We are up 20% as of end of a previous year. A previous week, we were up 20%. Come on. How long can the market continue to go high? That's a question as a natural you will ask. Are we overextended? Right? So the idea was maybe if we are expecting corporate profits to go 14%, then we might still have a tailwinds. Now, the bigger question is how much of this 14% is already priced in, which nobody knows. But I'm not going to go out of the market and sell my positions thinking, oh gosh, markets are up 25%, 20 more than 20% for 2 years, more than 3%, more than 3 times, having returned more than 20%. We haven't seen in last 75 years, or maybe you have seen only once. Maybe, who knows, that the next year gonna be the first time. As long as the basic fundamentals of business or the economy still stay strong, there is no reason for us to panic just because something has gone higher. I mean, is S&P egregiously priced? That's what we need to look at. Is that growth is supported by expectations of future earnings? If yes, then that's fine. A third thing is interest rates probably have peaked. We're seeing, a cut in interest rate. We got 50 basis points cut earlier. And now we had some of the least consequential FOMC meeting of the recent times. That doesn't really matter. We know we're going to get 25 basis points. Market wasn't expecting anything different. You can't do much. Now there is a change of administration. Jerome Powell will be there or not there, who knows? But Fed gave another 25 basis points cut and market didn't even flinch. There was no movement in the market based on whatever Fed did, because market has made its movement prior to that anyway. Right? And I was actually listening into and I don't even know. I mean, I after lunch, I thought I'll go out for a walk. And no, I think it was prior to lunch. I just went out for a walk so that I can, tune into the after a decision press conference. And all the press conferences are always the same. I don't even know why I tune into it, but so what? I can get my walk. And but only question that I liked in the press conference was, I think one of the reporter asked Chairman Powell saying, now we have a new president-elect in the White House, and if he asks you to resign, would you? And Chairman Powell says, no. One word answer, no. And the reporter saying, can you follow up on this? Are you not legally, you have to resign if a president, asks you to? And the answer was, no. That's it, one word. I'm like, that's the best one. Nothing saying more than what is needed. No was the answer. No, that's the only thing I liked. Otherwise, it's all the standard stuff. Every time reporters will try to get something out of a Jerome Powell and he will not say anything, right? So how the market did from a sector perspective, pretty good, man. S&P is up like 25% for the year. 25%. So, and the worst performing sector is up 8%, which is like what you can get in a high yield corporate bonds. So this year hasn't been probably not a good year to stay invested in bonds. You could have closed your eyes and throw a dart on any sector, you'd have still outperformed the bonds, right? For the most passive investors, which I guess if you don't love the business of investing, if you don't like to follow through the company earnings, And S1 scares you, 10K or 8K, 10Ks and 10Qs scare you. S&P 500 is a perfect way to invest. Even that is up like 25% for the year. Come on, what more can we ask for? So pretty good year. So fear and greed index, it moved into greed phase. Some says animal spirits are back. We saw some SPACs out. We saw some stocks of that sometimes remind me of 2021. Some stocks are going up like 40%, 50% after earnings. I think it's too early to say are we in 2021 bubble or not, because still a lot of money is sitting outside. $6 trillion is still sitting in money market funds. So it's not that all the money has moved in. So if we are thinking, gosh, God, we are already up like 25%, and a lot of money has moved in, $6 trillion is still sitting outside. I still know a lot of folks who have been waiting for a crash to happen so that then we can invest in, right? Imagine, let's go back and look at what we have in SPY, right? Oops. Let me go to 3 year. Right? This was the November 2022. Right? Scared the shit out of investors, like from on October. Sorry, all this was no, not sorry, the October, right? October 22nd or something, or 14. There was a lowest point 348. If got scared out of from here from 348, markets of course has not been up in a straight line, has its own ups and downs. Gosh, if you're waiting to invest, or if anyone has been waiting to invest, I'll invest in once I get a little cheaper price. I think Peter Lynch has summed up really well, is more money has been lost in opportunity waiting for the market crash to happen than it has been lost in the market crashes. We lost more money just waiting for on the sidelines, waiting for the opportunity cost. So that's why don't try to time the market. Don't try to go too big. If I don't need anything for the next 2 to 3 years, yeah, it's in the market. I don't know what will happen in next 2 to 3 years, but human ingenuity, we will still continue to innovate. Companies will continue to do, the economy will continue to grow, and the stock market, that's what it's a reflection of the economy and how the companies are doing. Short term, we will see these animal spirits coming in, or the desperation setting in, like we had it in October 2022, or we'll see a euphoria of 2021s. That happens all the time. But long term, market is an indicator of how the economy and how the corporate profits are doing. And that's what it is. Ross is asking, okay, let me look at a question. How does national debt affect markets and how can you measure? National debt is at $36 trillion. I think from a US side, we are still a little bit protected because we have a reserve currency. We can just inflate away the debt. National debt it impacts a lot of emerging markets whose debts are denominated, in US currencies. They impact them a lot. We will just print more and inflate away the debt. The downside of that is the rest of the world now has started. The rest of the world has understood this game, which US has been playing for now last 50 years. Because dollar is a reserve currency, and we've been being fiscally irresponsible, having a debt of like $36 trillion. And with the last 2 years after we shut down, we basically shut Russia out of a SWIFT network, rest of the world has started to figuring out how do we move away from dollar. Not going to happen in next 10, 15, 20 years, but slowly and steadily, I think the rest of the world is thinking we need to figure something else out. Maybe start to hold something else in our reserves than the US dollars. If US dollars is not fiscally responsible, someday, 50 years later, maybe take another next one more generation, the ship, the water is starting to fill in this ship from a small hole. Right now it's a pinhole, but it's gonna grow bigger if we don't fix our way we are spending. Has happened for thousands of years. Go back and look. Every civilization, if you look at, when they start to inflate their currency away, starting from the Romans all the way to what we are seeing now, is the civilizations will fall. But it takes long time for it to happen. So I'm not worried about, at least for my generation, next generation. Maybe that's why if you see, look at look at the gold performance. I don't think we ever had a year when the SPY is up 26% in a year and the gold is about 30% for a year. Gold is considered as a safe haven when you have when there's a fear in the market or the fear in the economy, that time you tend towards gold. But why is gold gone up 30%? I don't think it has ever happened. Very unusual that both are going up. It's because at least this year, a lot of central banks are loading up on gold than US treasuries. China has been reducing its US treasuries for now 2 to 3 years. So Chinese central bank, Indian central bank, they have been loading up on gold, and that's what we see such a strong movement in gold for this year. Gold has actually outperformed S&P 500, and both are positive. That has not happened. I don't think that's ever happened. But this year it did. And I think market is trying to figure out that, come on, the US is being irresponsible. And of course, we don't want to, no central bank or the country would want to stay always at the mercy of US goodwill. And they say, gosh, if I can find another way to store my wealth, which cannot be confiscated by US government, like what we have done for Russia, then yeah, might well do it. And that's why it's like gold is up so much. Ross is saying Buffett has moved his portfolio in the largest ever cash. Yeah. I mean, if you look at I think there's a Buffett indicator, which basically tells up the GDP versus market cap growth. It's screamingly saying, hey, we are euphoric. But Buffett has his own timelines, right? He can be patient. Buffett can't find deals in this. I mean, there are no deals available of bigger size of the capital that Buffett wants to deploy. He might find deals in the smaller companies, right? Medium-sized companies that probably will benefit from lower interest rate, right? But you can't deploy $50 billion in that company. So, do you think Buffett is losing money by waiting for the crash? Buffett is making 6%. He's not losing money. I mean, if not, nothing else, he's making $15 billion just by holding it in the treasuries, right? And again, losing money depends on what that you want to do with that money. If you've already, there's a saying, right, in investing, if you have won the game already, why play? Carl Icahn, $25 billion, he's like 85 plus or whatever, he's 80 years plus. $25 billion, he still played. And now he's reduced down to $5 billion. We talked about how it's one of the bet went haywire, it crashed, and is why you played? You already won the game. So it depends on what Berkshire is going to do. That's why don't follow anyone, because we are all in the same stadium, but we're all playing different games. Right? Buffett might be okay in making 10% per year. That's it. That might be, and with that, he might still win in his game that he's playing. So there is no reason for him to try to make 25%. and take a risk that he'll probably end up negative. He might as well, like, I don't know what Buffett is doing. You can replace the name Buffett with any other investor. He might be better off to do only 10%, but with the 0% risk that you're going to lose capital this year. That scenario might be good for someone who's already won the game. I don't need to accumulate too much. I just need to preserve what I have. So we don't know what game Buffett is playing, so we cannot just replicate thinking what he is playing or what I am playing or what game you are trying to play. We all are in the same stadium. Each one is playing its own game. That is why investing is way more personal than what the Wall Street firm talks out to be. Treasury returns may not beat inflation if we start printing again. Yeah, I mean, that's true, but he already won the game way earlier, right? So his returns for one particular year, if his returns are not in line with S&P 500, who cares? So don't try to follow. Don't try to follow Buffett, or don't try to follow me or any other investor. You need to identify what game that you want to play in the stadium, right? And then you have to devise your own investing strategy. I've lost money trying to replicate someone else's game. Doesn't work for me. It won't work for you. Once in a while it may work, but doesn't work in a long time. So you have to figure out, maybe write what's your investment philosophy is. It'll be a good exercise. Maybe use this week to write down what's your investment philosophy is, and then see, is your portfolio reflecting that investment philosophy? Cool. All right, let's look at a crypto market. There are tailwinds with the new administration being in place on the crypto, because few things that have happened over the last year or two is around SAB 121, which is Staff Accounting Bulletin passed by SEC. They did not have any legal jurisdiction to do this, but with White House and being favorable to choke point 2.0, who cares? So repeal of SAB 121 might happen. And if you guys recall, I think in July or somewhere, I talked about it, that even both, it was a bipartisan bill, which was passed. It passed Senate, passed House, was sent to President Biden. He vetoed it, right? And if SAB 121, the repeal of SAB 121 happens, which now there's a high probability that it might, that'll be very, they'll have a huge tailwinds for the crypto side, because now the banks will get into this market. I'm not going to get into the details of what the SAB 121 is at a high level. So today, banks are not able to custody, let's say, Bitcoin or any of the crypto assets, right? I'm not going to talk about a particular one. So if you are holding crypto, you're holding with Coinbase, PayPal's, or the word Galaxy Digital, or pick any of your other custody solutions, Fidelity Digital Asset Management. But how about banks? Right? Banks custody your money for 100 years, like 300 years. Bank have been custodying people's wealth. Why not crypto? Because of a SAB 121. And now, if this is repealed, banks will have an ability to jump into this market and make money out of a thick fee, right? This crypto fee, at least for now, because there are very few players, is very, very attractive. It's like, I think, 150 basis points on an average. So it's very attractive business. Banks have been shut out of it. Number two, there will be clarity in the rules and regulations around how the DeFi will work, and what is security, what is not a security. Over the last 2 years, SEC has been, it's like enforcement, regulation by enforcement. They don't tell you what the rules are, and then when you play, they'll come and sue you saying you violated the rules. Like, come on, you never told me what the rules are. We've been requesting you tell us what's the fair rules of the game. You never told us. So that's what it was called, regulation by enforcement, right? So that will go away. Third is US has recently sold, I think Germany sold some 6,000 Bitcoins or something, and then US sold a little bit. But US is a big holder of Bitcoin. I think it's the third biggest holder in the world of Bitcoin. I think after Satoshi Nakamoto's wallet and maybe MicroStrategy. I don't know, between MicroStrategy and US government, who's the bigger one? US holds a lot of Bitcoins, US Marshals, right? Now, if they don't sell it, I mean, that's that again, this was one of a Trump's promise that we will stop selling the Bitcoins, which US government, US Marshals hold. So that's going to be a tailwind. And the biggest one, and I think that's the most far-fetched, is crypto bulls are assuming that maybe Bitcoin could become a strategic reserve asset to be held by Fed. Why hold only gold in Fort Knox? Maybe add 5% of your overall asset as a Bitcoin. And if we don't know whether it will happen or when it will happen, but if it does, that's going to be a tailwind on Bitcoin, because could it spark a new race among the other central banks to start holding this as a reserve asset? I don't know, but I think that's the most far-fetched. Even if that doesn't happen, I think the market is already euphoric that now we got a little more crypto-friendly president in the White House. And look at what's like last 7 days. Now Bitcoin actually is at a new all-time high. Bitcoin, let's look at what's the new. I mean, prior to the election results, 73,000 was its close to 73,000 was its all-time high. And now I'm looking here. 23 hours ago, it hit its new all-time high at like 77,000. So the crypto is, especially the Bitcoin is all-time high. I don't think others have gone on, but Ethereum this week has jumped out. I've not looked at what's happened in the Ethereum ecosystem this week. There are too many things happening this week. Earnings, presidential elections, FOMC. So I didn't even look into the details of what new stuff has happened. I just assume that every crypto is going up because of a new administration, and that's what caused Ethereum to go up. But yeah, a lot of I would say a positive momentum in the crypto market with the new administration in place, will be in place. So we'll see. I think there are a lot of folks around Donald Trump to advise him on how to bring the talent back to US, because nowadays I think Dubai is becoming one big center of crypto related companies. They're going opening shop or registering themselves in Dubai because of all the enforcement going in on the US side. So we lost a lot of talent of the projects, but we'll see. We'll see what happens. But market doesn't wait for it. Look at what happened to Coinbase. Some of these crypto companies, it's up like from 180 to 270, like up 30%. What that makes 30%? I think it's like more than 50% up after the elections are out. Same is the case with some of these miners, Riot, Robinhood. Robinhood has got dual tailwind. A financial services sector, plus it's also on crypto. So a lot of, yeah, so that sector is expected to do good. And that's why it's a lot of this Bitcoin sector is always up. But you got to do your own. uh, I've been watching this sector for many years, and 50% drawdowns, 80% drawdowns are common. I don't know if we gonna get another 80% now, but yeah, 50-60% drawdowns common. It is part of being in this crypto ecosystem. So it's very volatile. If we start seeing more of traditional financial companies coming in, that might reduce the volatility a bit, but we'll see. Another one, I think, fun fact is IBIT. Was it I think it's IBIT or across all the Bitcoin ETFs? In 10 months, we launched the Bitcoin ETFs in January. In 10 months of the launch, Nut has got more asset under management, more than the GLD, which is the biggest gold ETF. And GLD has been around for what, 25 years? So there is a lot of, if you go on to Twitter and search for, I think it is iBit. Yeah, so a lot of money flowing into these crypto related ETFs. So, oh, we'll talk about UPS maybe later. So, yeah, so that's all on an overall market quick update. Any questions? I think we skipped crypto for last few weeks, so I want to break that back up because you see a lot of actions on the crypto side. XRP. I didn't look at XRP. What's happening? Yeah, because XRP had been in the, I mean, there's a lot of regulatory concerns with XRP that we have had. They sued the market. They sued the SEC. SEC had egg on its face. XRP didn't move much. The XRP is nothing but a Shiba Inu. And I am 100% sure we will see the derivatives or the, the neighbors of Shiba Inus and all those meme and meme coins back in the market. Uh, we'll, we will have those euphoric moments always. And especially the crypto market, you can create a coin, a new crypto in like 10 minutes, right? Especially on Solana, etc. You can create in 10 minutes. There'll be hundreds and thousands of these things will be created. Those will be pumped up, and there'll be pump and dump continue to happen. There is a completely separate. And I was so surprised in one of the conference, there was a whole presentation on how to profit from meme coins. It's like someone is coming over how to profit from pump and dump on a penny stocks. Of course, you can't do it because it's a regulated space. You can't even go and talk about it. But crypto is still unregulated, and someone is actually presenting you a strategy of how to profit from pump and dump on the meme coins. At least they are very upfront, saying we have nothing really worthwhile. This project has got nothing. It's just a meme coin. It's just like it'll go up. And how to figure out who is where the next bag holders are coming from and how you not invest. It's really not investing. How you speculate in that, right? So we will see that. Always happens. I'm not surprised anymore. So every crypto bull season will bring its own set of meme coins. So So I'm waiting to see I think 2025 may be a bigger bull run because generally after the halving, it takes 12 to 18 months. So we'll see next year what new names, come on the top of our memory. Shiba Inu and Dogecoins were the memories from 2021 bull run. 2017s were all ICOs. So we'll see what brings in 2025. So portfolio updates, again, not an investment advice, but I want to be a little transparent. Is I bought MELI, and there was a question on why I bought MELI. So when we look at the MELI results, I'll address that. But I think this is my one of the most from a dollar value perspective, one of the big trades that I've done in this year in one single trade when I bought MELI. Because I think Wall Street was too short term and they killed the stock. So I thought it was a good opportunity to buy it. Sol did good. Sol has done great, I think, this year. Solana is at some part of our time, Sol was down to 30s. I don't know, was it earlier this year or maybe late last year? Even if you look at earlier this year, Sol was at 75, now it's hitting close to 200. Again, Sol is a home for all the meme coins right now. It is becoming a meme mecca. But again, I think it's too early to declare which projects. I think except Bitcoin, There's still a lot of competition going around, which will survive for a long term. Whether it's going to be Ethereum ecosystem, whether it's going to be Sol ecosystem, we don't know. It's too early to determine yet. Okay, I didn't sell anything. I don't know. I mean, if you really wanted to sell, this week was one of the best. Week was the best time to sell because market was all-time high. You never have had the best time to sell in the history of the markets than you had this week. Yeah, I didn't sell anything. What's coming up in the next week? If you thought the earnings were over, which is what I thought, because this week was crazy, especially I think it was a Thursday. I had a 7 earnings on Thursday, right? One starting at 5:30 a.m. in the morning. So I was up like 5 a.m. and then post market close, there were 6 stocks that were reporting earnings. It was a crazy week. This week was a crazy week for me. So I hope next week will be a little easier. And it does look like I've got only 5 stocks that I'm interested in tracking for the next week. On Tuesday, it's Shopify and C Limited. On Thursday, it's Disney and JD.com. On Friday, it's Alibaba. Why is Alibaba reporting on? Oh, it's before open. Yeah, so okay. Friday morning still makes sense. So, so I will actually use the time to get through some of the earning transcripts that I have to go through. I didn't see Nvidia here. It'll be a crime and a sin if I miss Nvidia meeting. I think Nvidia is week after that. So Nvidia is 21, 11:20, 11:20. So Nvidia is a little later. Oops, this is Nvidia, right? Yeah. And it's 11:20. That's going to be a big week. I don't know if it's going to have a watch party. It's the last quarterly result. There was a watch parties organized in New York City. So that tells you so much of a euphoria. But Nvidia will be the week after that. So yeah, so I'll get some time to go through some of the earnings reports this week. I'm falling a little bit behind. It takes time. Those reports are big. So now I think it's time to there are two. I have a two agenda like I mentioned earlier. One is go through the earnings of various stocks, maybe do a quick rundown on that. Or the other one is go through the summary of the McKinsey report, which talks about where we should invest for the okay. Report doesn't talk about where we should invest, but report talks about the sectors that they think will outperform the rest of the economy over the next 20 years, right? Not 2 months, but next 20 years. What do you want to go through it? There are various earnings. I think I got a Uber, Meta, Alphabet, Apple, PayPal, Mercado, Coupang, Jupia, Doximity, and Palantir. And yeah, McKinsey. All right, I got 2 more. I mean, we'll come back to earnings if once we're done with the McKinsey. Give me your choice, or otherwise, hold your peace forever. All right. I got three votes, all for McKinsey. So 100% want McKinsey. So let's jump onto the McKinsey's report. I'm not going to go through all the 200 plus pages, but if you are interested in going through, let me give you the link. Okay, so this is the link. So the title is the next big arenas of competition, right? Arenas are the industries that transform the business landscape. 18 future arenas. So we're going to look at 18 industries that could reshape the global economy and generate 29 to 48 trillion dollars in revenue by 2040. Right? It is very, very difficult, if not impossible, to predict the future. That is why you see a very wide range of like 30 to 50 trillion dollars of revenue across its 18 sectors in next, I would say, 15 years or so. Right? So if you are a stock investor, earnings report, etc., is all in hindsight. Right? That's a past. We need to look at where I should invest for the next We all of us talk about, gosh, I should have invested in Amazon in 2000. Wouldn't that have been great? I should have invested in social media companies in 2010, right? So now here's an opportunity for us to look at what are the areas for the next 20 years. So what are the arenas? How you define an arena first? Right? So arenas are the unique category of industry which has got two characteristics. One is a high growth, and there is dynamism. Dynamism means there's a lot of a change happening in the industry, a lot of players moving up and in and out, or the market share has been changing in that industry. So that means it is still not decided who's going to win. Right? So they've identified 18 potential arenas, which could have 29 to 48 trillion dollar and have a profit of 2 to 6 trillion dollars worth of profit, and could become a share of global GDP from 10 to 16% of global GDP. Before we look at 18 arenas, we also want to look at, this is really worthwhile going into 18. So they're going to review the 12 arenas of today, right, which they had identified, like say 2005 to 2020, how those 12 arenas have performed. Right? And then we're also going to look at what are the portions that actually create those arenas. What are those things that an industry needs to be qualified as an arena? And then are there any early markers of that you can tell you, oh, I think this industry probably could become an arena. Right? And then eventually, finally, we will look at what are those 18 arenas. Okay, so 12 arenas of today are software, semiconductor, consumer internet, e-commerce, consumer electronics, biopharma, industrial electronics, payments, video and audio entertainment, cloud services, EVs, and information-enabled business services. Right? So these arenas generated less than 10% of global economic profit in 2005. By 2019, it had a 50% of economic profit. Right? So there's another chart for you to look at how these arenas have performed. From a market cap perspective, in the 15 years, it's become almost 9x. For the rest of the industries, which are not arenas, it was 2.4x. So it kind of outperformed the rest of the industries or order of magnitude of 4 times. Pretty good. I would want to be invested in such companies, which could outperform the rest by 3 to 4 times. Revenue-wise, same story, right? It was up like 4 times in over 15 years and outperformed the other industry by, again, 2 times, 2.5 times. Right? Overall, the number of like 637 companies, you can look into this chart if you want to dip deeper into this. But looks like whatever the way they've identified arenas, at least over the last 15 years, it has shown results. Right? Some of these, and it's not that these arenas will just die down. So we will also look at, out of these 12, how many arenas will continue to be arenas of tomorrow for the next 15 years, next 20 years. You don't always have to reinvent all the industries, right? Some of these industries will continue to outperform the rest of the market in the next 15, 20 years. So those will like continuing arenas. Some of them might transform itself. Today, what we call as video and in last 15 years, what's called as video entertainment industry could transform itself. And, out of that, there's a new industry comes out, which is called the streaming services, right? Streaming industry. So there are things that will continue to stay arenas. There are arenas that will transform itself into adjacent or related business or might split into 2 separate arenas. And then there are few arenas which are completely new. So we're going to look at all the 3 different categories. But before that, let's look at what are the current arenas and what are some of the companies of those that will give you a little bit insight into, what is the meaning of these arenas and when we talk about these terms. Software companies like Microsoft, Oracle, Adobe that maintain and distribute software. Semiconductors are the companies like TSMC's, NVIDIA's, etc. Consumer internet is Alphabet, Meta, Tencent that provide consumer with internet services such as email, social media, internet games, etc. E-commerce are, I don't have to talk about e-commerce companies, Amazon, JD.com, Alibaba, pretty self-explanatory. Media and consumer electronics are the companies like Apple and Samsung that engineer and manufacture personal consumer electronics or the mobile phones, smartphone, tablets, etc. Right? They don't categorize Apple as a tech. They say media and consumer electronics. Biopharma are the Amgens and Regenerons that manufacture drugs based on biological materials. Industrial electronics are the companies like contract manufacturers, Foxconn that manufacture all the iPhones of Apple. Apple doesn't manufacture itself. Apple is a designer of iPhone. It's all manufactured and done by Foxconn, right? Jabil, Flex. So these are the companies that manufacture stuff. Also are other OEMs, the names that we generally don't hear about: Panasonic, Siemens, ABB, Austria Brown Boveri, which manufacture electrical equipment and all that. Payments companies, Visa, MasterCard, Amex, which provide payment transaction services. Video and entertainment, Paramount, Disney, Netflix. Cloud services, we all know EVs, BYD, Tesla, and also the divisions of a traditional automotive companies. Like GM has a EV division, Ford has a EV division. I think every big automotive company has a EV division now. So they're going to look at, when they're looking at the overall how EV grew, they're going to look at, of course, the pure play EV players like Tesla, Neos, BYD, Rivians. What's the overall revenue? Plus, what's the revenue of Ford EV? What's the revenue of Toyota EV? Right? The EV divisions of these companies. Finally, information-enabled services, which is like firms that have benefited from the explosion of information age: Deloitte, ADP, Experian, Equifax, TransUnion, etc., etc. I think gives you a little more way to understand when they talk about these arenas, what kind of industries or the companies they're referring to. Okay, how these arenas are different from non-arenas. What are the characteristics? They have an increasing economic profit. Right? If you look at the arenas, the 2005 arenas had only $55 billion. All the way to 2020, arena gained from 55 to 290, whereas other industries actually lost profits. They require more R&D investment, so it doesn't come at cheap. You need to continuously invest in R&D, and they look like 67% of the R&D investment is going into the industries that we are categorizing as arenas, enabling new entrants to grow. This is where a lot of a shifting comes into, because arenas make it easier for the newer players to come in and disrupt the market. Share of the market cap held by new entrants in 2020. New entrants had 33%, 1/3 market cap of the arenas. Right? So and that is why a new company maybe have a much bigger market cap, and you were wondering why it is. Maybe it's a part of one of the industry which are categorized as arenas. They spawn giants. Arenas are the industries where you have companies which are $1 trillion companies. You don't get those in a traditional industries. And they're a lot more concentrated. We always, how many times we've talked about, gosh, S&P 500 has become very concentrated. Right? Top 10 companies are now account for 40% of S&P 500. Maybe those top 10 companies belong to those arenas. Right? And it's concentrated and operate more globally. Right? They're not restricted to a particular region as much as the other industries are, but I don't think the difference is that stark. So these are some of the characteristics. What's the secret sauce? What happens? There are three two secret sauce. One is what drives them is technology and business model step changes, not gradual changes. Not that, hey, I got a better machine to produce the same footwear. These are the these are the step changes. A big change, either in your technology or in your business model itself. So for example, the first portion ingredient is a technology or business model step changes. For example, TSMC. Right? We are moving into nanometer. We are operating in nanometer level area when it comes to the chip manufacturing. Right? So that's a technological step change. The invention of EUV and usage of EUV to create those chips. That's a technological step change. Netflix streaming is a technological step change. We didn't talk about how to manage your supply chain of Blockbuster better, or maybe how to reduce the late returns by the video cassette renters, right? That would have been a gradual change in existing business. What Netflix did was, I don't even want to talk about renting the DVDs or the video cassette tapes. That's a technological step change. We're completely moving to streaming. Then there will be business model step changes. Right? One which is very clear over the last 15 years is from a licensing model to the subscription model. Right? No one-time license fee. I'm going to milk you, Mr. Customer, year after year. That's a business model step change. How you may not make money. Right? You might be having the same software. So it's not a technological step change. The same Word document that you've been using, of course, there have been incremental improvements in the Word document, but whatever the functionalities that you and I have been using for Word document over the last 10 years, still the same, right? We still don't use much of the functionality, but there's been a step change. I would have been much happier to pay one-time license fee of $100 to get a MS Office and use it for next 10 years, because I don't use any new functionality anyway. Microsoft doesn't allow me to do that anymore. They did a business model change. I have to pay for Office 365 online subscription $100 year after year. Even though the product feature is still almost the same, but that's a business model step change. Other business model step change that we have seen in the last 10, 15 years is social media. Okay. Social media spawned a completely new industry. As a consumer of all the benefits of social media, I still don't pay anything for free. Who's paying for it? It's an advertisers, a new business model. So these are the step changes you will identify either in the technology side or on the business model side. Right? Second biggest portion is escalation mechanism for investments. Right? The investments continue to increase with scale. And these outlays not only grow the output, but fundamentally change how the company produce the goods or the services that it produces. Right? It's not that you open one more additional factory or 5 more additional factory doing what you are already producing right now. No, that's not an escalatory mechanism of investment. That's a regular investment. You just up the dollar value of what you're doing it. Right? But the escalator investments are one in which it changes. The more you invest, the better your business process itself becomes. Right? And so that's another portion of industries you will see in escalatory investments going in. And secondly, the players begins an arm race in which they iteratively invest to scale, and they have to scale to invest. Isn't that a wonderful term? You have to iteratively invest to scale your operations, and then you have to scale it because then you invest more in it. Things that we have seen in cloud players. 10 years ago, 15 years ago, the Wall Street firm, if you're not thinking this term, might be just crazy. What the heck is AWS doing, Amazon doing, and building so much of a data center capacity? And that race is still not finished. It's still going on. That business needs scale, and you need to continuously scale so that you can, and when you scale, you get more profits, and you get those profits so that you can invest back in it. Not all investments are escalatory. Now, don't go back and run a screener and says CapEx and rank it by, okay, CapEx is 50%, more than 50% of the revenue, I'm going to buy those stocks. Not all investments are escalatory. Even though the CapEx is investment, not all of them are escalatory. Right? In the steel industry, building a new plant might increase overall profit. It will increase your CapEx. It will increase your capacity, but it is in the same production function. It's not an escalatory investment. But in e-commerce players like Amazon, optimizing last mile delivery fundamentally change not their scale, but give them a unique capability that no one else has. And that completely changes the dynamics of the industry. That is an escalatory type of investment. So you have to figure out, when you're looking at industry, is it just a regular, I'm just upping up my CapEx without fundamentally giving me an additional moat or adding to the moat that I'm trying to build? So that might qualify as escalatory investment. If not, then it doesn't fall under it. It may not, that industry may not qualify to become an arena of the future. Okay, these two are the big portions. And then there are charts which tells you how these companies, TSMC, Apple, Microsoft, how they have been continuously investing into R&D, basically R&D and CapEx. Okay. When it comes to software, I consider R&D as a CapEx investment, even though the accounting does not. And we talked about it, why it is. I'll repeat it. If you are spending in R&D, accountants consider it as an expense but I consider it as a CapEx because whatever you're spending in building the software, the benefits will be coming out in the future, right? So it shouldn't be considered as an expense in this year. You should be amortizing it, depreciating that over the years like you do when you buy a machinery. But I'm not an accountant, and accountants are slow to change their rules, so whatever, we'll live with it. So, but I like that the report from McKinsey actually added both the R&D as well as capital to tell you what the overall investment is. Third portion is it's got a large or growing addressable market. These investments are no good if the market is shrinking, right? So that, I think, self-explanatory, that there is a demand for these products continue to grow. Okay. All right. So what are the markers of likelihood of these arenas forming? So what they looked into is there are three things which will tell you, is this in this industry, is there chances that there's an arena forming in this industry before it actually, because you don't, if you don't know, how some of the companies may be just private, you don't know what's the investments happening in that company, right? You can't figure out their R&D investment, whether they're escalatory or not. But if the industry is becoming an arena, it might show up some characteristics, some markers that if you follow, might give you a hint, this might become an arena of tomorrow. So there are three markers. One is the venture capital investment continues to go in those industries more than it goes in other industries. Other is the valuation multiples. They enjoy higher valuation multiples, sometimes crazy valuation multiples. Third is the revenue continues to grow. So you would see and then basically look at, biopharma, the VC investments. So the benchmarks, let's say 2003 was 1.1 across all industries, biopharma at 4.5, consumer electronics 3.0. Now, not everything occurs at the same time, I guess. So these are the three things. Again, you don't have to go through the detail, but now if you're thinking, and while I was going through, I'm like, the stuff that I'm seeing in AI right now doesn't sound to be that crazy, which I thought it was before I read through this report. And that is why I thought I should definitely come and talk about this report, because it tells you when you're seeing stuff happening in the industry, it might tell us something. I did not know about how the things have moved from 2005 to 2015 to 2020. But if we are seeing similar stuff happening, then it may not be as crazy as what I thought it is. So high VC investment, higher than normal multiples, and revenue continue to grow more than the normal growth of revenue. Right? These may be markers. So now let's look into the final one, which is like arenas of tomorrow. These are all the past. I wanted to go through the back. I could have jumped into the slide of, hey, these are the arenas of tomorrow. But that is like, doesn't give you any information on how we arrived here. Should we even pay attention to this or not? That's the reason I thought I'll go some background so that even if you identify a company and you're seeing, my God, this company is going to go higher. What's happening? Is the revenue growing, VC growing? You might be able to put some more color on it and think for yourself about that industry or about that company. That's the reason I thought I'll go through this to give you some background. Now let's look at the arenas for tomorrow, which is for us as an investor is the most important thing to do. Arenas of past is past. Gosh, my dad should have invested in it. Dad, why did you not read the report of McKinsey 15 years ago, right? But arenas of tomorrow, revenue could grow. We already looked at that. The numbers, now they've identified 18 arenas. Right? Now, these are the 18 arenas for tomorrow. Okay, can I get everything together in one screen? Alrighty. Then this should do it. Okay, 18 potential arenas of tomorrow. They look at their current 2022 revenue, right? An estimate of 2040 revenue. Okay. Then there are profit estimate. I think this tells us what's the higher and the lower end of revenue, I guess. Yeah. So, or I mean, the darker blue tells you at the lower end of estimate what the revenue is, and at the higher end of the light blue tells you the higher end of the estimate. So, which will tell you how much of uncertainty may be priced into this particular industry. And this will tell you the same thing for the profits. So e-commerce currently $4 trillion of a revenue across in the world, and 40 estimate is anywhere between 14 to 20 trillion dollar. Not going to go through all the numbers. You can look into the report. But e-commerce, AI software and services. See, the things have changed. If you go back and look into the previous 12 arenas, I think it was saying just software. Now it says AI software and services, cloud services, EV, digital advertisements. We didn't see it in previous 12. Semiconductors, still there. Shared autonomous vehicles. This stuff doesn't even exist. There's no revenue here. Space, this is a new one. Cybersecurity, batteries, new one. Modular construction, new one. Streaming video, new one. Video games, new one. Robotics, industrial and consumer biotech, new one. It was a biotechnology. Now we got industrial into it. Future air mobility, no revenue right now. Expected to generate 75 to 340. That's why the range is much higher, because a lot more uncertainty into it. Look at the range in robotaxi, shared autonomous, 610 to 2.3 trillion. Drugs for obesity and related conditions, Eli Lilly, Novo Nordisk, GLPs, nuclear fission power plants. All the deals that we are seeing happening now. So these are the next 18. Now you can categorize these 18 currently. They contribute to 18% of global GDP, expected to contribute to 34%, almost double their current contribution. Sorry, the lower scenario is 18, but not the current one. On the lower end of the range, they're expected to contribute 18% of the global GDP. At the higher end of the range, it will be 1/3 of global GDP. Right? Substantial amount. Now, let's look at the categories. Right? We looked at 12 arenas, and I told you some of those might continue to be arenas of tomorrow. Some of that might transform themselves. Some will be a completely new industry. So these four already existed. The top four existed in. They are currently they are currently arenas and will continue to stay arenas: cloud services, e-commerce, EVs, and semiconductors. These four will continue to be arenas of tomorrow. Some of those spun off. Consumer internet spun into digital advertisements. Right? The consumer internet like Meta, etc., Google now will become a digital advertisement, because now that itself becomes a much bigger part. That's a much bigger part of the revenue than the rest of the stuff. Software spinning into AI software and services, and video audio entertainment becoming streaming video. These are the new emergent arenas, the 11 remaining ones, right? Which today either we have a very small portion of our revenue, or these were not even listed as an arenas or in the previous report. So why other industry considered might not emerge as arenas of tomorrow? There were other arenas, now that has dropped off. 5 arenas of today lack the growth and dynamism through 2040 to continue as arena of tomorrow. Biopharma, consumer electronics. Apple devices is now in more than 2 billion people. Then they got non-Apple devices. How much more can you grow? There's not much of a growth. Industrial electronics, information enabled services, payments. Now that doesn't mean to say, so this is not in company specific. This is at an overall industry level. It could still happen that Apple continue to outperform because it's taking market share from other players, and Apple might continue to grow, possible. But this report it as an industry level, right? So as an industry, there may not be too much growth left in the smartphone industry or consumer electronics industry. The dynamics within that industry could change. Okay. Now these are 8 emergent arenas, right? Which the thing could be an arenas of tomorrow, right? If they could become, some of them could become, but these are emergent ones which they have not considered it yet. These are almost emergent, and 15 years is a long period of time. Some of them could actually move in here. So keep an eye on this one: hydrogen, carbon material, fusion, products and services for older adults, because the world population is aging, renewable energy generation equipment, sustainable fuels, VR, AR, and finally Web3. Okay. Some of them, nothing might happen. Okay, yeah, so then the report talks about, remember we looked at what's the signs of portions in future arenas. Escalatory investment, and the step changes, and then the report goes into each of these arenas, prior arenas, and tell you how these things changed. From an e-commerce, social commerce, what were those things? So if you're interested, go through it. I went through because it helps me to understand the space and look when I'm analyzing an industry. It helps in your thinking when you're trying to find out, understand what is possibly a step change here. Right? What's possibly a business model change here? Tech model change, business model change. Right? What could be of another business model change in cloud? I think from a subscription-based servicing, we might be moving to consumption-based servicing. Oh, sorry, subscription-based pricing to consumption-based pricing. Right? We might be moving from, rather than from buying a service to buying a microservice. Right? Renting out a microservice. I don't have to rent out the server. So last 15 years, we had to buy the server. Now, why do I need to buy a server if I all need is is, let's say, computing capability, power. I could just rent it out on AWS. I'll go to AWS and I select, I want this processor for so many days or for months or for years. The next one could be, why do I need to rent out the computing resource? I should just be paying for like what am I consuming? Like Netflix. Business model could change in the future from paying a monthly rent to based on how many movies I watch or how many hours am I streaming content. That could be another business model pricing change, right? From a subscription service to consumption-based service pricing, right? So that's the, and then the report goes into, for each of the 18 arenas, they'll give you a gist of what that arena is, what are the companies in that, and then at the end, they'll get into further details into each of these arenas. If you're interested, let's say in particular sector, go and read through those reports. I thought that would be too much for our discussion, but I hope this helps you in understanding and think about investing for future. We all are very familiar with the S curve of any industry, and we want to invest when the S curve is about to form, continue investing when it's going up, and start to taper investment when the S curve is at the top, because then it becomes mature and you might still give money in that because it'll continue to pay you dividend and might be buy back the shares. But then you need to find out what are the next emerging areas, which is the next Amazon of 2000. What's the next Netflix of whenever Netflix came out? I hope this 40 or 30 minutes that you spent helps you, or at least give you enough information for you to get interested and go and read that report. It's a 230 page plus report, but I think it's worthwhile, the time well spent on that report. Questions? No questions. Either I did a great job that everyone understood, or I did a horrible job and put everyone to sleep. Come on, wake up. All right, thank you. Okay, Kristen is awake at least. No bit of climate change, air conditioning. I think there's something related to sustainable energy. I think, but that's not in it's not in arena right now. It's sustainable fuels and renewable energy could be an emergent one. Because again, the case is they may not have seen the escalator, the VC, like venture funding should be high, revenue growth percentage should be high, and then higher multiples. Even if it's a private company, can still fund those multiples. Those things may not have yet appeared in renewable energy or sustainable fuel. We talk about it a lot, but where's the money? Where's the dollar going in behind this? So they may not have. So it is still kept in almost emergent area. Might show a high growth dynamism, but have not analyzed because there's uncertainties when it might happen. Maybe it'll happen up to 2060, right? So that's all. Do you suggest to enter at this level? I can't suggest anyone to anyone. You have to figure out which industries you are more conversant with in these, and then find out which companies you want to pick up from that industry. So how I use this report when I was looking at it, like semiconductors, because I know semiconductors are a cyclical industry. It always have its growth, or it's a phases of capital investment, and then there will be lull period, and then again next tech step, the step change will come, another capital investment. So I was like, based on what's the semiconductor over the last 2-3 years has been a great investment, and I was thinking, should I trim? After going through this report, and when I look at semiconductor, that the range of the semiconductors seem pretty tight, means that the uncertainty is not that much. And from a profit margin perspective, it's still expected to return, from a much higher profit margin than some of the other industry. I'm like, yeah, I'll hold ASML or like some of the other companies for next 15 years. So it helps me. You have to figure out what works for you. And if you're invested in this, or maybe if you're invested in some of the companies that were arenas of past, and you want to think about payments, is PayPal, Visa, MasterCard continue be the big revenue, the big market beater for the next decade? You might want to think about it. They've been market beater for the last 20 years. McKinsey suggests that probably they don't have that much growth built in as an industry level for the next 10 years. So am I going to add more to, some of these? May or may not be. But you have to think about that. As an industry, it may not continue to grow at 30% rate. Right? Individual companies becomes different. So give you some framework to think about it. Okay. Any other reports from other companies to read and compare? I didn't come across any other report. If I'll come across it, I'll come and talk about it. The worlds also seem to have gone silent on blockchain because the VC investments have pulled back on it. And it is an emergent area. Web3, including decentralized finance. If they see more VC funding going in and more, the problem on the blockchain side is the lack of revenue. You have one portion, one key marker, which is VC. We saw the VC funding in 2021, but we didn't see the other key marker, which is the revenue growth. Not much of a revenue coming from Web3. Right? So, but it's still they kept it as an emergent side, but it's not yet become an arena. Cool. All right, we have 17 minutes remaining in the session. Like I said, I have to get off my seat at 12:15. We can jump into some earnings now. Oh, let me sip some water. So a little riff, then we'll jump into earnings. Okay. I did tweet about it. So what happened to Mercado Libre? Net revenues were up 35% year over. So anyone needs an introduction to this company? I don't know. There are some new people today or not. Nope. All right. So Latin America. So that's why you need to see this FX neutral, which will tell you the operation, how good the management is managing its business. And then because they're listed in US, they have to report dollar based. So the difference you see is because of foreign exchange currency conversions, right? So dollar wise, they were up 35%. If you ignore the FX headwinds, they were up like 100%. Right? So it means management doing okay, but they can't control the currency devaluation. They can't control the forex. So it is what it is. Still 35% year over year is good. It's already like a $4 billion company and growing at this pace. Income from operations of 557 million. It was down 20% year over year, right? So, and then, so basically they missed the EPS. EPS expectation was $10 and they gave only $7.83, right? Huge miss. Almost more than 2.2% miss on the EPS, which is bad. Okay, total payment volume. So they got an e-commerce business and the payment business. Payment is becoming much, much bigger and bigger. Volume was $50 billion, up 34%. GMV was up 14%. Margin pressure. So what happened to the stock after that? Stock was down 17%. And if you have if this is your biggest portion of portfolio, I'm like, look at the drop from almost 2100, it fell down to 17, lowest was 1745. So what happened? What spooked the markets? It was because the margins were under pressure. I think earnings was fine, revenue was fine, but the margin was under pressure. And then the algos will start to kick in. And it was down 7% when I wrote the report. I quickly gave a update, and then by the time that the market finished, it was down like almost 16% for the day. So what happened here? If you are a Mercado Libre investor, you're definitely spooked. So then I went through the details to understand what the heck. So this is what happened. Market got spooked because operating margins is 10.8% only as compared to 18.2%. Forget about what was expected. Even if you compare from a 2023 to 2024, it was not good. So there are the 740 basis points difference. I think this is why it is important to understand beyond the headlines. What is actually happening here? So they grew their credit card business a lot because management says now our risk modeling, we have made it better over the last 2 years. We have more faith on it. We can go and grow our credit portfolio of business, of which the credit card became from 25% to grew from 25 to 39% of their portfolio, which increases the volume, but it's a lower margin business, right? That impacts margin. Number two, that's why we are moving up the customer value and risk profile. We want to identify lower risk customers, give more loans to them. But if you have a low risk customer, you actually get lower APY, right? You'll not survive in the market if you charge higher interest rate for a lower risk customer, right? So, but if you charge the lower interest, that impacts the margin. Even though the volume may be higher, but it impacts the margin. Third is accelerated pace of origination. So the overall credit business grew up 170%. So what happens in this industry, if you give up, your total volume grows higher, the interest will come out later, right? You spend the money on your credit card. So if I'm a company that gives you that loan, you spend the money, but the interest that you're going to spend or the interest income that I will get will come later. But as a company, I have to account for a bad debt. It's not that the debt has gone bad, but I have to do that accounting. You have to provision for bad debt. So that was the biggest hit to the margins, because they've grown it in such a short time at a higher rate. They had to provision for the bad debt. They had to provision it more, and that was the biggest impact on margin. Number fourth is, I think this is a good thing to do. In Q3, they changed their terms and conditions, saying if you are prepaying your installment on some of the loans, if you are prepaying it, then we will refund you some of the interest income. They did not have to do it for the customers for a previous quarter, but what the management was saying is, hey, I thought we should do good for the customer. So we went years back and gave refund to everyone. It's only $4 per customer. But I think from a customer delight perspective, this is a good thing to do anyway. But it impacts margin in the short term. Fifth one, they're building, putting a lot of investments in building the logistics network, just like Amazon did in 2013, 14, 15. I don't recall. And Amazon stock was hit, but Amazon was invested in building those warehouses so that they can do 1-day delivery. But remember, initially Prime Day was only 2-day delivery, but Amazon was building those warehouses. So MELI is doing is they want to double the capacity of the warehouses in Brazil. And this quarter, they built 6 warehouses, 5 in Brazil, 1 in Mexico, but that impacts your margin. Rest is normal course of business. So they gave a nice chart on overall comparable where this get into. So the biggest portion is bad debt. It doesn't mean that you have defaulted or they have already classified is a bad debt. It's a provisioning for the bad debt. And we've seen this happen a lot more during the COVID times. JP Morgan's all the big banks, they had to increase the provision for a bad debt, which hit the margins for the particular quarter. Right? And then when we realize, yeah, not everybody's going to die. Economy is not going to come to a grinding halt. And then the bank started to take that money out of that provision. And in the later quarters, those started to add into the income of those banks. Right? So if you look at it, biggest came from this. Right? Only from the cost of goods at sector, only 2.2%. Right? But the biggest one was from this one. And then, the market and G&A, which was the refund that they gave. And the long LTRP was their warehouse and all that. I'm like, these are strategic investments. And I'm perfectly okay that they're doing this. It is to increase their moat and grow their credit business portfolio. So I thought it's a good opportunity to buy it. So that's why I bought MELI. I went and I picked up some MELI. And that's why I added it in my portfolio. So we'll see. So I think I bought at 1825. I bought at 1800. And my last buy was at 1770. So I actually did 3 transactions on MELI this week. And I'm fine. I'll continue to hold this. I think this company has still lot more upside. And I'm not worried about it. So that's MELI. Okay. All right, let's jump into maybe another 2 earnings. And which one? Let's talk about another very, I'd say Twitter followed stock is Palantir, right? And you guys know I talked about Palantir last year, able to pick up some nice stocks at a very low cost basis. Net, Palantir grew their revenue almost 30% to 725 million. Gross profit is 30%. Forget about the numbers, right? All understanding revenue on a total revenue up 30%. I think commercial revenue is up 44% or some 40%. They beat on revenue, but they missed on EPS, right? But the stock went crazy, right? It is interesting to listen to into the earnings call, right? Statement coming from the CEO was, given how strong our results are, I almost feel we should just go home. Right? Another words that were used by, we have eviscerated the expectations or something that sort, right? 30% quarterly growth, net income grew 244 million. Look at the stock like ripping. I mean, it has outperformed NVIDIA. It's up 252% for the year. 252%. I don't think NVIDIA has so much. I may be wrong. I didn't know what happened to NVIDIA in last 2 days. But let's see. NVIDIA is 206%. Come on. Jensen Huang, you need to work better. Alex Karp is beating you. So stock is up 252%. It's now approaching $60. And if you recall, I have a covered call at 45, which I'll not be defending it. I had some covered calls at, I think, 28, when I told you, hey, some shares got called away because I had a covered call on it. I'm not didn't want to defend it. Now it's approaching 60. Now, as an investor, you keep thinking, oh, gosh, is it really justified? I don't know. But so I wrote a little longer post about Palantir because I've been in this stock for almost 3 years now. I think in August, I celebrated my 3rd year anniversary. I bought this stock at 26 in 2021. I bought the stock at $6, $7, $8, and then sold at 17, bought it back at 16, whatever. I've done multiple transactions on this one, mostly buys, few sell because covered call get assigned. So I wrote a little longer than usual. I said, you can Palantir. This is like another Tesla. Okay. It's a lot of retail investors are very, very passionate about the stock. As I sold a covered call, I did it this week at $60 now. And if you recall, I had actually come and talked about it saying when I did 45, I probably want to hold my coffee can quantity and not do anything on the coffee can quantity. But I kind of changed my decision. I want to take you through my thinking process. Not that you should follow, but you have to think for yourself. So I'm telling you what my thinking process was. I had earlier decided not to sell a covered call after my 45 call got trampled by the stock, but I can't be at a peace if I don't take some risk off the table. Agree, it's a great business. Their foundry, Gotham, now their AIP is making all the waves. It is called a tailwind of AI behind it. But a great business can become horrible investment if it's not done at a right price. So here's what drove my decision. Looking at the metrics first. 30% revenue growth. Great. But I've seen many companies doing more than 30% in software. It's not great. It's good. At a $2 billion, you're growing at 30%. It's good. Not that great. Right. Mercado Libre as a 4% growing at 35% year over year, despite the FX headwinds. Operating margin still sucks. Trailing 12-month operating margin is only 14%. I can understand if you are a hardware company. Amazon 14%, fine. They got a AWS. It's a retail company, lower margin, right? But for a software company, 14% sucks. Google, Microsoft, greater than 30% operating margin. Microsoft is more than 40%. Return on invested capital, that means if a capital you invest in business, this is not the stock return. If I'm giving $100 to business, how much economic value is business creating? Because eventually that's going to determine the stock price. It's only giving 7%. Share dilution is continuing. 6% share dilution over the last trailing 12 months, higher than my threshold of 4%. And now more share appreciation rights. It works differently. That's giving ESOPs. Long back talked about it in terms of it's a good thing to do it, but now it hit those thresholds of $50. Many executives get a lot of shares. When it hit a threshold of $60, many executives get a lot more shares. So more dilution is coming in. Margins look like a consulting company, not a product company margin, because very low margin. And so I went into its not only its quarterly report, I went to its S1 the SEC filing, not not just the shareholder letter, earning presentation. I'm like, where does it go break up of what's the cloud revenue, what's the professional services revenue, what's the on-prem software revenue? Every good software company will give you this breakup because they want to tell the street, value me more because my cloud revenue is growing faster than the rest. Palantir, no breakup. I'm like, why are not they given the breakup? Maybe the PS component is much higher, and that's why it's a lower margin business, because PS is a lower margin business. Fourth thing, Alex Cobb mentioned in the earnings call that, I grew 30% year over year without spending anything on sales and marketing. And every retail investor is going, well, see, we don't have to spend anything. Word of mouth business. Saying is one thing, reading into the statements is a different thing. So if I look at the P&L statement, they spent $209 million on sales and marketing, which is 80% more than what they spent on product development, which is only 118 million. Well, that doesn't jive. Either you say that I spent 209 million, don't come and say that you don't spend much on sales and marketing and still the business is growing. And analyst actually says, why should you invest then? If your business is growing so much, I think you should invest more to grow business more. But I don't know, they're spending 80% more on sales and marketing. Okay, I can ignore everything if it is reasonably priced. PE is 290, PS is 47. And you can argue that PE is backward looking, but I'm looking at prior quarters. I look at forward PE 127. Okay, higher growth companies will enjoy higher multiples. So how about PEG? Looking at PEG is 5. More than one PEG is reasonable. More than 2 PEG is expensive. I'm okay to hold expensive stocks. More than 3 is egregiously expensive. One lesson that I learned in 2021 was when a companies become egregiously expensive, take some risk off the table. Right? Maybe the market doesn't get it and still pricing thinks 60 is a reasonable price. And these are some of the tailwinds that I'm aware of. Warp Speed, their manufacturing OS, may not be priced in. International expansion, which is not yet happening, but it's a big tailwind for them. Maybe political tailwinds from incoming administration, right? Peter Thiel, big fan of Donald Trump and invested in Palantir, right? But these are all the birds in the bush. Only reason I see is the sucker keep going up. That's the reason if I'm still holding it, is a sucker will is damn thing still going up. So, but I could be wrong. Probabilistic, right? I'm not deterministic. Yeah, I'm right. I think this all rest of the market is crazy. So I'm still not selling covered call against 100% of my position. I'll have my schmuck insurance. I'll still have hold some coffee can portfolio. My cost basis is $6.72. So even if it gets called away at 60, I think I made my gains. Then I rest my case. This is the reason why I sold some covered call on Palantir, and you do what you want to do. So there is a Gutta is asking, what's your guess on the future about Palantir? I just told you that, right? I'm still bullish about the business. I can't say the same thing about the stock, right? So that's my theory on Palantir, and with that, it's time to go. We cover 2 earnings. All right, guys. Thank you everyone for joining in today, and we'll talk again next week. One housekeeping that now I remember is no session on 23rd. I have a parental duty. I'll be chaperoning, so won't be able to do the session. I could have done it from the hotel room, but I have to chaperone, so I have to be at the event. So no session on 23rd. I will cancel it on Meetup, giving you 2 week advance notice. Go find something great to do on that session, something other than sitting in front of laptop or a mobile. Uh, no session on 23rd. Alrighty, thank you. I'll see you next week. Until then, a happy hopefully all of you have a profitable week. A week doesn't matter much, but it will lift up the spirits. Thank you. Bye-bye. Alrighty.